Did you ever hear people in the investment world say a stock is too expensive or it's overbought? Guru investors like Warren Buffett even mentions that price is what you pay and the value is what you get. So how do you know how much value you get for how much you pay? How do you know if the stock is too expensive? There is a simple financial ratio that gives a quick insight if a stock might be too expensive or relatively cheap compared to its peers. That's the price-earning ratio, or short for PE. So, how does it work? P ratio basically divides the share price of the company by its earnings per share. In other words, it divides the value of the company by its earnings. To give a simple example of this, let's imagine you own a lemonade stand. In a year, let's say your lemonade stand makes $1,000. And if someone buys your lemonade stand today, they would buy the whole business for $10,000. That means your stand has a PE ratio of 10. So what does that mean? It means that someone is willing to pay $10 for every dollar it makes in profit. You might be asking if that's good or bad. Well, you don't really know unless you compare it with your peers or similar lemonade stands. So let's compare it to two other competitors. We know that lemonade stand has a PE ratio of 10. Now, one of our competitors, let's call them McLemon, has a PE ratio of 20. Our other competitor, let's call them Lemon Bucks, has a PE ratio of 5. If all else being equal in terms of selling the same products and having the same sales growth rates, Lemon Bucks would be a bargain to invest in, since you'll be paying $5 for every $1 of earnings. McLemon would be the most expensive, since you'll be paying $20 for every $1 of earnings. So does a low PE ratio always mean a good thing? Unfortunately, no. Like everything else in the investment world, things are a bit more complicated than that. High, low, or even no PE ratios could be good or bad depending on the situation with the company. A high PE ratio could mean that the stock might be too expensive, but could also mean that the investors are expecting big returns for the company, so it could be justified. A low PE ratio could mean that the stock is cheap, but it also means that investors are losing confidence in a company, which is driving down the share price. No PE could be a red flag and means that the company has not produced any earnings in the last 4 quarters. On the other hand, a lot of high-growth tech stocks or unicorn companies focus more on funding their revenue growth rather than trying to turn a profit. I find that the best way to complement the PE ratio is to supplement it with more research and other financial ratios. Now let's look at real-life examples. At recording, Apple is one of the largest companies in the world. Their share price is currently valued at $300 a share and has a market cap of $1.3 trillion. Using their last full year's earnings, Apple has a PE ratio of 25. Now it's hard to find a 1-for-1 comparison like our lemonade stand for Apple, but let's use the largest US companies. I know that companies like Apple and Amazon aren't in the same business, but it does give a sense on how the market in general might be pricing them. At a quick glance, you can see that Apple is at a relative discount. With the low PE and the large stockpile of cash, this could be a reason why investors like Warren Buffett has taken a long-term position in the company. Next company that might jump out is Amazon. Amazon is a tech company that is disrupting the traditional retail space. Amazon's PE ratio might seem high compared to its peers, but investors believe that its high growth rates and its ability to take market share from other large retailers, such as Walmart, justifies the high PE. Also, Amazon's PE ratio compared to a few years ago has been cut in half, suggesting that its earnings has been rapidly increasing. PE ratios have other variations as well. 2 important ones are TTM, which stands for trailing 12 months PE, and forward PE, which uses future earnings. These basically do the same as current PE, but it's adjusting for more recent earnings or future earnings. PE ratios help investors providing a quick indication on how stock is currently valued by the market. With other analysis and research, investors can make a sound decision on whether a stock might be a good purchase or a bad purchase. Thanks for watching, and please subscribe.